The Relative Strength Index, or RSI, is a momentum indicator that helps identify whether the market is overbought or oversold. It ranges from 0 to 100, with key levels at 30 and 70. When RSI is above 70, it suggests the market may be overbought, meaning prices have risen too quickly and could soon correct. When RSY is below 30, it indicates the market may be oversold, meaning prices have dropped too sharply and could soon rebound. Looking at the weekly S&P 500 chart, we can see how this plays out in long-term investing. In March 2020, during the COVID crash, RSI dropped below 30, marking a strong buying opportunity as the market soon recovered. In early 2018 and late 2021, RSI went above 70, signaling potential peaks before corrections. This method isn't perfect, but it helps long-term investors time entries and exits more effectively. While RSI is useful, it should be combined with other indicators like trend analysis and moving averages for better decision-making. Overbought doesn't always mean a crash, but it does suggest caution, while oversold conditions often indicate a good opportunity to buy.